Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Maddie Radner, as well as remotely Brian Joyce, both on our Nasdaq market intelligence desk. And we have Arnim Holzer, global macro strategist at Easterly EAB. With us in studio, we're here to discuss why investors need to remain engaged with the market while maintaining a balanced risk orientation. It is great to have everyone with us. Welcome back. Arnim, it's been some time here, and your thesis around remaining engaged, maintaining a risk profile, it's playing out in a day like today.
Yeah, I think, first of all, thanks for having me. Nice to be here, Maddie and Brian. First of all, I think investors need to recognize that the market does have a tendency to go from bottom left to top right. The path can be tortuous, though. And in the past, the way investors dealt with that was simply by diversifying with fixed income. The difficulty here is fixed income, much more volatile, and it's at the center of this inflation talk. So how do you deal with this kind of risk and this kind of not smooth ride? We think you need to engage with volatility, and we think for retail investors that's been a little bit of a scary proposition, but we think it's becoming much more important given the kind of moves that we're seeing of late.
And it's interesting because there's a lot of conversation around the unknowns and the uncertainty and so forth, but at least we know, there's one certain thing we know is at some point there is going to be a resolution. So this isn't specific to a systemic breakdown in the market, because at the end of the day, corporate results, fundamentals, and so forth, that's what's going to continue to drive market performance. And now that some valuations have become more attractive, there's a lot of cash on the sidelines too.
Well, first of all, we've talked about this with the energy market. It's true with stocks too. The solution to low prices is low prices, and there's some values out there. That said, it's important to understand the tariffs are a known. In other words, Trump has been talking about this, President Trump has been talking about this, the market's been preparing, but there are still ways that this is going to get played out, and we don't know all of those, but we have an idea. And I do think it's much more of a one-step, potentially 6-month kind of adjustment period, and stocks should be a discounting mechanism into the 2, 3, even longer time frame. And some of the stocks that we're talking about that have been hit the hardest are in those kind of time frames where there's a lot of good news to come. The difficulty is understanding how is this volatility going to play out, and what other sectors that we don't really know well, or we haven't quite seen where the risks are, how they're going to play out. And so there is still some risk.
Of course, but Maddie, we were talking about it this morning on the desk where, okay, we know what the unknown is. There will be some sort of a resolution. We have to kind of get out of the mindset of buying the dip or instant gratification. Yeah. But if you think about your small caps as an example, there are some sectors where the new tariff structures could provide some momentum.
There's definitely some pockets of opportunity within all the volatility that we're seeing, specifically within the small and mid cap space, who are well off their November highs, but that could be seen as an opportunity. They're very discounted and could be a great opportunity. And when we think about the tariffs, the immediate consequences of them won't have much of an impact on some of the small and mid-cap companies who are more based in, have domestic kind of operations and suppliers. So a lot of these companies who are not as affected by the international trade might actually benefit, and compared to some of their larger cap counterparties.
Especially the smaller cap names, they have very niche markets. And again, if they're already based in the US and domestic production is part of their profile, they just kind of have to wait this out and see what the structure is going to look like at the end of the day.
Yeah, we're actually seeing specifically small cap utilities up 3% when we look at the Russell 2000 sector. Really one of the only sectors within that index that is up year to date, but that is because they rely more on domestic production for their profitability.
It could be a catalyst finally for the small caps to get off the finish line, the starting line here. Brian, let's take a look from a technical perspective. S&P 500, give us some fresh levels to watch. What's going to be key for you, where your new areas of resistance and support are here?
Certainly, Jill. As you can see, we tested today the 200-day moving averages. We came within maybe 0.3% of that level, which is 57.27. So it's a widely watched moving average. If we zoom back out to when we're coming off the lows of the prior cycle, 22 Q1 23, we could see right around there it had held, dipped below it for maybe a few trading sessions, but not much further than that. This 200-day moving average coincides with the price gap at this horizontal dash line, 57.8384. That is the price gap from the November 5th election and the reaction afterwards. So I think that's a key level to watch. We're seeing, a nice bullish reversal here today. This is a common bottoming candlestick pattern right here. So particularly for your short-term day and swing traders, I think those types of investors can use, today's range as a clearly defined risk level to trade against. And we're seeing something pretty similar in the Nasdaq 100. If we look at the Nasdaq 100, the 200-day moving average, if we zoom into the first quarter of 23, we could see it certainly did act as support, along with the 50-day moving average crossing up above it. And since then, we've seen, significant pullbacks, which were in the summer and fall of 23, in July and early August of 24. Again, that 200-day moving average. And so here we are right now, today, testing that average. We dipped down below it, probably triggered some stops. And after they've been shaken out, it's now reversing higher. So looks here to me like a similar bottoming candlestick pattern, just like the S&P 500.
All right, Brian, we'll be back to you in just a moment here. But Arnim, I also think it's important to point out when we went through COVID and that extreme volatility shock that we saw there, on a longer term chart, that's relatively a blip on the radar. There's, a generation that has not traded through prolonged volatility. It's two very different scenarios here.
Well, there are two issues. One is, I think volatility was somewhat muted by what the government did afterwards.
Right.
But correlation has also been muted. So the beta that people have experienced, in other words, the way stocks work against each other, has not been as macro-oriented as I would have expected given the last couple of years of events, whether it's geopolitical or interest rates. What you're seeing now is a slightly different view where the macro sense right now with these tariffs is actually fairly high. I do think the VIX is going to come off this boil a bit, but there is a little bit of concern. Is in fact, is there going to be a difference in sectors? Are you going to start seeing small cap and mid cap sectors now start to actually perform or not? Is the Fed really going to do what Fed funds futures are calling for, which now is 3 eases by the end of the year, when 2 weeks ago was literally going to still be 1? I think those factors are going to make the intra-sector moves a little bit stronger and do warrant understanding how you position. So the traditional way of going to fixed income and just assuming that that's going to diversify you, it's a little difficult because the Fed hasn't really said we're going to ease, but the Fed fund futures are kind of front running them.
Right.
And so those set up different macro risk that we really haven't seen before, because before the Fed said we're going to raise rates. The Fed said we're going to ease. Right now you're kind of in a limbo, and just because we've had some tariff issues doesn't necessarily mean that they're necessarily going to ease just because the yield curve has come down a bit.
Right.
So that actually portends some risk still in the system that if you just look at volatility, you might miss. Because vol may come back down into the 17, 18 range, and people may say, okay, we weathered that storm. But unless correlations really give the signal that it's not a macro environment, I would be careful about going back to the old way.
I also think it's important to point out that the economy and market are two very different things, and the Fed's not going to make a move or change their strategy just because the market's having a temper tantrum.
100%. So we had a disappointing productivity number. I like going to productivity because productivity really talks about what companies' earnings are doing. So if you have decent productivity, you're going to see decent earnings. Earnings projections are not coming down. The S&P projections are still looking quite good. Small caps are kind of aggressive. We'll see what happens. I think if you did get 2 or 3 eases, small cap, you could actually get a pretty decent earnings growth in there. But without that, it's going to be a little more challenging. However, in the S&P and in Qs, I think the earnings projections are still quite good. Now, we're going to get a 4th quarter productivity number in 2 days. In May, we're going to get the first quarter number. If those numbers come out basically in line with what happened in the 4th quarter, which was a little bit of a deceleration, it was understandable because of the fires and because of the storms. But if we get an acceleration in that number, in the May number, I think the earnings numbers are going to be pretty solid. And that's why I think that this flattening of the yield curve was a little premature, because we don't know yet, and the earnings expectations still look relatively solid, albeit we're going to have higher vol, we're going to have higher correlation, so you got to diversify. Things like hedged equity make a ton of sense here. We manage one of those funds. But I would be very careful about just going to cash, because I think you're really risking when you get back in. Mm-hmm. And I'm fairly convinced we could have some good data points in the next 2 weeks, and it might be a big head fake.
Right. Well, it's almost like, taking the contra side of that. If everyone is thinking one way where it's extremely bearish or bullish, that's sometimes a good indicator to take the other side of that, especially when you're trying to time the market and get in. It's usually a little bit too late for the average investor, such as myself. But you had brought up vol before. I want to bring Brian back into the conversation. Brian, from a technical perspective, how is the VIX setting up? It seemed to be, on Monday earlier this week that it was almost in a position where it was ready to coil one way or the other. How are you looking at it?
Yeah, I really much agree with what Armin was just saying there about, maybe, we're nearing maybe the top of this move higher in the VIX. You can see right now, it touched yesterday around 23. It's pulled in a point or so below that. But if we go back over the last 12 months or so, we could see it very rarely has it gotten above that. Just, this prior time in December was when we had that hawkish rate cut by the Fed, where they then signaled that they were going to move into wait and see mode. And then before that was in July and August, where we had some volatility as well. And we saw, big pullback in many different areas of the equity market. So I feel like we're kind of in a similar situation now. The market has really been correcting the stock market, since late November. I think the S&P 500 was really the only major index that made new highs in January, but the breadth was much weaker. Maybe half the index was trading above its 20-day moving average at that time. And so more recently have seen those big mega cap growth stocks beginning to correct themselves. And they had previously been what had been holding up the market when we were talking about the weak breadth all throughout, mid to late 23 and early 2024. So I have a feeling a lot of that has, been played out right now. And I think, the more attractive risk reward for stocks would be, I'd rather be a buyer here than a seller. And for VIX, I would expect that maybe that would pull back as well. Obviously, there's, hard to predict what could come out of on the geopolitical front. We have a congressional, we have the president speaking in front of Congress tonight, State of the Union address. So anything could be said that could, throw a near-term curveball. But we have seen a pretty sizable correction in many of those individual bigger cap names, which we hadn't seen in quite some time.
Yeah.
It's an interesting point that, as Brian was saying, the breadth wasn't great, but if you look at it on a global scale, the breadth actually in the last 6 months has actually improved because you started to see investors think about what are the impact of tariffs. Well, you're probably going to have to see stimulus. Europe was going to move towards stimulus, right? The ECB is going to move towards stimulus. And what you've seen is some of these foreign markets actually start to perform a little bit better, almost anticipating the effect of tariffs. Now, the question is, now that the tariffs are here, is it going to be a sell the news and come back to cheaper US equities? I'd be very careful about running out and trying to follow the momentum in European stocks because it's not clear to me, and it looks to me like Japan is probably strong enough now that they're going to keep raising rates. What's the impact of that going to be? Which leads us to one other issue, which is we are a little concerned about the elevation in the level of the VIX and not really seeing credit spreads widen. And so to take this talk maybe one step further, investors have really been piling in to credit, maybe at a longer term. I think credit is interesting, particularly in the shorter term, but I'd be very careful about things like high yield because of the lack of connection between the VIX and HYG vol. It's 4.5 and it's trading on a 5. It's really, really cheap. The correlation of HYG is normally close to 60%. It's up at 70% now. Right. So what's going to happen there? I think that's a place where investors need to be a little bit careful because if there is some short-term slowing, there's going to be a feeling there.
Yeah, well, it's interesting too when we saw the extreme outperformance of the European markets relative to the U.S. And to your point earlier, there was risk to the upside because the valuations were just so much more attractive than the U.S. markets were. Maddie, another area that we take a look at is the IPO pipeline. Yep. And there was a lot of lofty expectations going into 2025 because we thought we were perhaps going to get more clarity sooner than later. What's the pipeline like now?
We are seeing a steady stream of companies move forward with their IPO plans. There's already been 57 IPOs across the U.S. exchanges, 70% of those operating companies, 30% of those SPACs. We're continuing to see filings come in. Actually, NVIDIA-backed CoreWeave filed yesterday. We're seeing a lot of AI-related companies, a lot of crypto and digital asset companies who may move forward in the back half of the year. Maybe because they're less reliant on the traditional technology supply chains. So we're still seeing that interest there. We're seeing interest from multiple countries, Hong Kong, Singapore, China, and Malaysia, to list here in the US. So even though it might be more as some of the volatility dies down and some of the uncertainty gets a little bit better, it is still expected.
Yeah, and Brian, one more time, we're going to bring you in before we start to wrap up here. Speaking of the U.S., anything you could tell us with the U.S. dollar and how it's reacting to tariff talk?
Well, as we've seen the rates come in, the dollar has come in as well. So we've seen a slowing in economic activity, housing a little bit weakness, retail numbers as well. So with rates coming down, the dollar has come down also, and so we can see that it's back down below. But I think it's not in the end all be all, but around that 107 area, which had been the high from 23, and we had tested it a little bit in November of this year. We did break out to new highs on a multi-year basis, but we've now pulled back. So, we're still trending lower this week. I would look to say that 200-day moving average around 105 as a potential level, and right in line with that is this pivot here on the uptrend in December. So dollar is in a downtrend, which is good to see, which maybe has also provided an additional tailwind for overseas stock markets.
All right, appreciate it as always, Brian. And to wrap up here, Arnim, at the end of the day, it's about capitalizing on the evolving landscape, whether it's regulatory, volatility landscape, what's happening with earnings and so forth. So, silver lining, there is still opportunity out here. And to think that experienced, excellent corporate management that we see in the U.S. has not been thinking about these scenarios would be naive in my opinion.
U.S. exceptionalism didn't occur overnight, and it's not going to be disturbed overnight. So there is still U.S. exceptionalism. The issue is, what's the pathway going to be? And do you need an SUV, or are you going to be able to ride, a regular, road sedan? I think you need a little bit more of an SUV. You need to be able to take into account volatility and correlations in your portfolio. You need to understand that this environment is a multidimensional environment. It's not a simple, okay, the Fed's going to ease, binary. And as a result, your portfolios have to be more robust. That's why we do what we do, and I think this is a perfect environment for it.
All right, we'll leave it on a positive note. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.